Money and banking. Money and banking is a very, very important subtopic in the macroeconomics because, like foreign exchange rate BOP, money and banking also carries 6 marks. So we are not going to lose the 6 marks of forex BOP, money and banking, and government budget. So remember, children, whether it is a direct question or a bit of twisted turns, we are going to ace it. I told you 5 problems, or money banking also will have 5 very important concepts that you need to grab. What are the 5 ones? Let's see. So 5 problems, 5 solutions. Let's see. Money and banking, 5 concepts to grab. Number 1, money supply concept. Only the M1 concept is there. That is currency in hands of people, demand deposits with the bank of the people, and other deposits, which include the deposits with RBI of foreign financial institution, foreign government, and Indian financial institution like LIC, NABARD and all. But no part of money supply is the money held by commercial bank, government, or Reserve Bank of India. Because government, commercial bank, and Reserve Bank of India are suppliers of money. And total measurement of money supply is the money held by the demanders, not the suppliers. Next is assumption of credit creation and legal reserve ratio. Legal reserve ratio is clearly cash reserve ratio and other variants like statutory liquidity ratio, vault cash with the bank. Since they are legalized by RBI, hence it is called legal reserve ratio. Also remember the assumptions. The entire banks of every unit in the country is called bank, one unit. A prudent banker knows that all the people will not come up to withdraw their money. Also, the prudent banker knows that there will be constant inflow of money. So whatever deposit they get from the depositors in their savings account or their time deposits in the fixed deposit account, those are called the primary deficits. And from there, they give out loans. And when the loan takers get their account opened in the back, those are called secondary deposits. So, what are we doing? Money multiplier. Money multiplier is a very important concept, which is won by legal reserve ratio that is being asked by the Reserve Bank of India to be there with the commercial banks. Also, functions of RBI. Other than printing money, custodian of foreign exchange reserve, helping in growth and stability of the country, very, very important. Number 1, the Reserve Bank of India acts as banker to government in 3 capacities. Number 1, banker. Number 2, agent. Number 3, advisor. You write this 3 and you get 3 marks. Number 2, as banker's bank. Supervisory function, again 3 capacities. Number 2, lender of last resort. Number 3, clearinghouse function, the detail of which has already been explained and uploaded in my YouTube channel, Economics with Nilanjana. So keep on following my YouTube channel and Facebook handle for around 30 minutes a day right now. And just mark my word, children. Today, the concepts I'm clarifying, or the question types I'm telling you, or the numericals that I'm doing with you all, you are going to get exactly like that. Next. Credit control by Reserve Bank of India. Credit control, that means regulating the amount of money that should be there in the economy, and for that they have several tools like bank rate, repo rate, reverse repo rate, statutory liquidity ratio, cash reserve ratio, open market operation, margin requirement of loan, and all these tools together is known as the monetary policy of India. Next. So let's see one numerical. Look, how much credit creation will take place if LRR is 5% and banks received an initial primary deposit of 30,000? What is this money multiplier or credit multiplier? We can call them by both the names. Is 1 by LRR. So 1 by 5% is 20 times. So total credit created by the commercial bank is money multiplier into initial deposit. Money multiplier is 1 by LRR. Initial deposit was 30,000. So 20 into 30,000 is 6 lakhs. So from an initial deposit of only 30,000, the commercial bank has been able to create a total deposit of 6 lakhs of rupees. This is how money gets multiplied by the commercial bank's process of advancing loan. So it is rightly said that not only though the Reserve Bank of India is responsible for increasing money supply, giving money supply in the economy, commercial banks also perform the function of multiplying the credit of the economy. Also, you have to understand one more thing, that total credit creation is inversely proportional to legal reserve ratio. That means higher the legal reserve ratio, lower will be the credit creation. So the banks have to give out more and more loans. Also, it is directly proportional to the initial deposit. Greater and greater money comes in the bank, greater and greater will be deposit creation. So now you can justify what we studied in rural development. That is what? Jan Dhan Yojana. More and more people putting money in the bank, more will the bank be able to create credit and increase money supply in the economy. Another thing, here in money chapter, this money multiplier helps to increase the GDP, because greater the money, more the investment, more consumption, more production, more employment, more income generation. So as a whole, it helps in increasing the GDP for performing the dynamic function of money, which is a standardized, universally accepted medium of exchange of the economy.